So from the eyes of the startup development phases, this was the situation before we created the development framework. This was the only picture available in Wikipedia, which is the top number page in Google. And the problem here was that it was only about the finance side. So it was only about the valuation, only about the finance rounds. There was not a journey from the perspective of an entrepreneur. So basically, not only was the perspective of entrepreneur missing, but also there wasn't anything leading towards the first finance round. So in the common terminology, this is also the situation that where we started, and we felt that a lot of the knowledge is missing. So it was only about 3 simple steps. You have the idea, you launch it, and then you scale. But this was missing the point about the team building, how to do the team building in a balanced manner to avoid premature scaling in context of building the innovation as well. Where's the ideation? So where does the ideas actually come from? Is there a systematic process to be applied to coming up with ideas? Versus everything in the startup world pretty much start from validating the idea. So everyone is expecting that the team already exists and that the idea already exists. This is where most of the knowledge started from. So we were specifically curious and focused on where does the ideas come from? Can more be done on the ideation level? And where does the team come from? How can you build your co-founding team? And how do you build the commitment? And then more of the validation part. And this part is, of course, very much available and documented through the lean startup phase and lean startup methods. But at the same time, that's not the only one. And most importantly, the lean startup doesn't cover too much, if anything, related to ideation processes. So we put these 3 key different phases below behind the idea is the idea formation and the team formation. Behind the launch, or between the idea and launch, is the validation, and not only the product, but also the team validation. And then is the growth. So how does the scaling happen? And basically, this is now a version 3.6 out of the startup development phases, and you can go to Startup Commons website and read the whole history of this document. See the very first version where it started from and how it's been iterated over the years. And really, it's capturing this from idea to product to business, and from talent to co-founding team to organization in a balanced manner, and looking in the ways to how to manage the risk of the most common failure factor, premature scaling, and also how to balance the overall development through these different steps. So we have the 3 key steps, and then we pretty much have like the entry and exit point of each of these development phases, and we have a very high-level description to kind of describe these subsegments of how the company looks like at that specific phase. And this is not a plan, this is more of a roadmap and milestones. So regardless of how do you get to the next milestone, that's your plans and strategies in the company, but the milestones are giving you kind of perspective of how does the company should look like when you can say having reached a certain milestone with this roadmap. Here's also kind of statistical perspective into, this is more from an ecosystem. If you look at how does the numbers look like in any given ecosystem, and the ecosystem sizes can of course change, but if we start from ideation, it's like what kind of volume of ideation. This is from a snapshot of quite significant ecosystem, but it's not any specific to any individual geographical location. This is a generalized average through different ecosystems. So in ideation, you have a certain number of potential ideas that never ever come into a company. In concepting phase, you narrow those down, you kind of throw some of those ideas don't even carry further enough. And you also start to see the number of people in any given kind of, this is like an annual cycle, like every year there would be this much. And also the funnel of how many you need to have to get to a certain number of success. On the commitment phase, this funnel gets shrink down quite significantly. There's separately then like SMEs or small businesses that can come out of those, but this is narrowing down to real startup co-founding teams with investment potential. Again, doesn't need to mean that they have to have investors or take investment, but they are shaped that way. And then through validation, a significant cut again in the numbers. And then on scaling, again, a significant cut. And then on establishing, again, a significant cut. And it doesn't mean all of the companies in between would disappear or fail. They can also just plateau to that level and become more iteratively growing companies. But this gives perspective into the types of numbers. So you can divide all the numbers by 17 if you want to see what that means in an individual successful company. But this is a statistical perspective just to give more view to the matter. So these numbers are much more relevant for the support organizations than for individual entrepreneurs, but it's also more important for investors, specifically for new angel investors, those who work in the support functions. So when we look at through the lens of a startup development phases framework, we have these two different aspects to focus on and develop both of them in a balanced manner. So from an idea to business and from team to organization. And in the individual modules we go through, both of these aspects together in each of the key development phase, like formation phase, validation phase, and growth phase. And when we look at the supporting factors or key factors, the money and connections, so the professional investors' value becomes much higher in the beginning. In the later stage, in the beginning, it's more about general knowledge, advisory perspective. Business angels are there kind of in between, bridging this. And also in any ecosystem, maturity of these activities and support functions are provided by public services, non-profit organizations, and these types of structures. And then the private side is much more when the validation is found and it's more about scaling. That's when it also naturally evolves more private side actors. And naturally there is a kind of linear transition between these support services. Some private companies go much deeper earlier. Some public services, depending on the ecosystem, extend much further, longer. And usually the reason is that if there's no private sector activities or actors enough, then public sector tries to accommodate. And when there's more private actors available, then the public sector tries to kind of give room to those private actors. So in each of these stages, we look this now from the perspective of investor, and investor in reality here means anyone investing money, resources, their time, money, advertising space, co-founder, anyone who puts something to the table. And not only someone putting money, so any return of investment, so that whatever you put there that's worth money, it's a resource, but you are anyway looking more of the upside. So not only, charity, so just giving it. So this doesn't include that kind of perspective. So everyone anyway have some expectation for the success. So at the very early ideation phase, it's about coming up with the potential scalable product and some business model, how we could make money, but it's just theories, it's just models to help understand the concept. Usually it's only one person or a very vague team. So it means that there is no validation, there is no shareholder agreement, there is no document to say that we are a team and these are our responsibilities, our roles, this is my equity position. So basically none of these are yet structured. And it also may be missing that there's, two developers and they feel we would really like to get a designer and a business person here. So it's not balanced in the skills to be able to execute the product or service at all key levels. So the investors view here at this point that it's just a dream, it's pie in the sky, a lot of work to get involved, and it really depends on the more experienced the investor is, the usually less involvement they want to have. So they still may be happy to help, they may be happy to give some, perspectives, ideas, but they really don't necessarily want to get involved. And the reason being because they know how much time is required, regardless of the money, they also know how much money can be lost and the likelihood of return of investment is quite low. But the more it's about new entrepreneurs, the more it's about, they're on their first journey, second journey, or those who can contribute part-time, or the first-time investors, and so forth. But definitely, at the same time, it means that the volume here is quite high because it doesn't really mean a serious commitment. So a lot of these things can be done and be part of. But the valuation at this point is zero. So there is no value because there's nothing has been validated, and in reality, nothing exists yet. At concepting phase, now we are kind of structuring some of the, milestones. We are structuring some of the activities that need to happen in between each of those milestones. Usually there is some kind of team behind starting to formalize that take on more responsibility of pushing this forward. And it starts to kind of shape up. So it looks something like this. So the idea is still vague. This is kind of where the value are evaluated based from. So the idea, okay, it's a nice idea, but what an investor would look like, they look at the team and they look at the market. Is this market growing? Is it big enough? Is this team interesting? Do they have relevant background? Do they have relevant passion and motivation to attack that market? And the value of idea is still quite low. So it's starting to get interesting because it's anyway further along than the previous one. Still very risky, and yes, the money doesn't really help the venture to grow. And this is different, where entrepreneurs feel the money would help us to do more of this. It's just lowering the personal risk and making it more comfortable to do and invest, but it doesn't make the company any better by having the money. It will have more resources from founders, but the founders are expected to stay with the company whether there's money or not. It's kind of like your child. So when you have a child, you take care of them regardless of your personal situation or monetary capabilities, you will take care of it. Maybe you can't take care of it as well as you would like, but you will take care of it. So at this phase, the valuation already can be something. And this, I said, the valuation doesn't really mean anything, but it's a number that you can negotiate. And the reason there needs to be a valuation is now if we think that someone would take a role, then if the value is 0, then anyone giving anything would get 100%. And it can't be the model. So therefore, a model to calculate something of value of the potential is useful. And if there is no valuation, it can't be used. And on the other hand, if ownership is already shared and someone is giving something in return, then basically you can have already a way to calculate what is the value through that means. It's not the same valuation as what investors would see. That's the valuation if they invest money, those in the Shark Tank. But it is a valuation, nevertheless, that some resources are already captured to be available to build this venture. But again, it's valuation for the calculation purposes, valuation not for investment purposes. So the commitment phase at 0 point, and this is why it's 0, because this is where things get more serious, is that before this, everything is just discussion, talk, theories, initial plans, initial promises of contribution, initial so forth. But at the point 0, the whole thing comes down to documenting this. So to committed and skilled balanced core founding team. So it's basically creating a shareholder agreement involving all of the shareholders and writing down what are the IPRs that the company has, what are the IPRs that each of the founders contribute, or how do they consider the IPRs, and basically also by being able to commit resources to develop the product or service without being dependent on uncommitted external resources. So the target would be here that if it's building a digital service, that there's resources to design it, to code it, and to sell it. So that would be a good balanced skill set and also committed skill set that regardless of finding funding, you could already create this product. So if you can't have this, then you can't prove that you can continue to progress. So that's why it's a validation for the commitment, validation that you are both committed to doing this and you have the resources to do it, at least at the very minimum level. So now, if we look at where the value is, now a significant portion of that value actually becomes communicating about the capturing the value in the founding team and the talent. The more divided skills there is, the more skillful they are, the more ambitious they are, the more committed they are, the better attitude they are, the more valuable the team is. The market is still important, and the value of idea has grown a little bit compared to the previous how and where there was the value to be seen. So again, investors' perspective, if they see this first time and not know the past, they may still consider, well, it's still something vague, and oftentimes founders fail to communicate what they have achieved so far, specifically from the team perspective, because usually the conversations are all about the product again. But if they would communicate, we have gone through building this team, we have a shareholder agreement, we have this type of commitment from these people, and so forth. It's important because if you understand where the value that they are looking at is, it's worth communicating that. But at this point, you may start to look at the, hey, if you know the past, specifically, if you know the progress, it looks much more appealing. And this is a point where you may want to consider joining as an advisor, even if you're an investor. Again, the valuation numbers here, they get this valuation if this is in, in Germany, or if this is in Silicon Valley, or if this is in Austin, Texas, or if this is in let's say Barcelona, if this is in Helsinki, if this is in Singapore. These numbers can also be very different depending on the financing and the other funding sources available there. But anyway, the point here is to communicate how much is now 3 to 5 times more valuable, or the valuation is higher than just the previous step. And again, this doesn't mean that you can get this type of valuation through an investor that would actually invest money, but you can get this type of valuation from advisor deals and that types for sure. Or if you can't, then there's something else is off. Market is not interesting. The product is not clear enough, or the product concept is not clear enough, and so forth. It can also be much higher. In a case of serial entrepreneurs coming from Supercell, starting a new gaming company, they would get much higher valuation just by their commitment that we are looking to build a new company. So many things matter. So the validation phase, now this is already that there is already a product or a service that is being iterated, and the validation is being looked at least an MVP, and or they continue to attract external resources. So people who work for equity, maybe some grants, maybe some public funding, maybe they win some competitions, but they are clearly now executing with the resources that they've got committed and tied into shareholder agreement and showing some progress. So now the value starts to grow more on the product side, and there's a whole new dimension here, which is the customers. Now there's something that can be measured through customers because the product starts to form, starts to exist. So now the value starts to grow into the customers. So while the market is the market potential, market share, other actors, the customers are dedicated, your customers, your company, your revenue source. So if we look at investors, here's the the point where they hit or miss. And this is the time, when Uber was in the beginning, and there are those investors who said, well, that will never work, and it was too early for them, and they figured that, well, we'll get in later, and this is the moment where the time window here can be as short as 1 month, 3 months, or it can be as long as 3 years. Like, there is no saying how long a company can actually stay in this phase. But the key point here is that you don't get unlimited opportunity to invest as an investor. As a founder, you go once to one investor, maybe you go maximum twice, and if they say no and you say no, you just most likely go to other ones. And again, it's not about the investors, but that's just one of the validation tools at this point. It's always good to talk to investors. It's even better to get a deal from investors. You still can say no to the deal when it's on your table, because the process itself is very valuable, regardless of whether the funding comes or doesn't come, or whether you choose to take it or whether you choose to look at it later. And there's no right or wrong answer. You have to take all the things into consideration at that time. Valuation, now again, I would like to highlight not just the number itself, but how much the number has grown from the previous phase. So this is how you build up the valuation, and these are things that are kind of very invisible, but it's important to learn to communicate what you have done and how the value has increased, and communicate it from the right points. So in between phases 1 and 2, this is the tricky time. This is the hit and miss phase. It's where assumptions get validated. If selected market or team is good, solutions and business models can be still changed, pivoted. Sometimes even whole business idea, and in some cases even the whole market is changed. But again, what is key that oftentimes the team is not. So in many cases of successful pivots, it was the exact same team that did it. The founders of YouTube, they started YouTube as a dating site. You know, the founders of Twitter, they started as a podcasting platform or something like that. But it was the same team executing, and based on their learnings, they found out something better. Or they didn't even find out, they just wanted to try something totally different. So again, the value of the team and how that matters. So the scaling, now it's not only about the business model working, it's not only about having customers, it's not only about profitability levels, it's about ability, it's about the trajectory, it's how it looks like, what is the growth. If it's a 10% growth month on month, which is, I think, in Y Combinator Accelerator, they try to get 10% growth week by week. So every week, 10% more. So if you can keep that kind of growth, you can have significant growth. So when they talk about growth, they take it very seriously. The level of growth they are trying to get is a key. So when it comes high valuations in a very early stage of the growth, it's all about the market, the trajectory, and what is the growth rate at the moment, and how long that can be expected to continue. So the Apple stock is starting to dive, not drastically, but has lost a significant amount of value when they came up with the communication that they no longer talk about the growth of iPhone sales, because they're not going to, by default, they're not going to anymore sell more units. It's just going to sell at higher price, and of course they have huge profitability on all the things that the iPhone enable for them, like 30% of all of the income from the app stores and so forth. But the key thing is that the growth curve and how well that can be sustained and for how long, or if that can be even accelerated, then that's the key factor for investors, how they look at it. So now, basically, the customers part has been it has developed balanced matter, certain value appreciation has been in the product, very little, then in the market, very little, then in the team, more. It has grown, the product has grown, the market has grown, the customers have now grown. And now the next level is the organization. It's a new thing, and the organization is the scaling machine. So you need an organization, you need a structure to manage the growth. And it's not only about scalable business model, you have to have a scalable model to continue grow your resources and manage those resources to be able to cater for the customers and the growing demand. So it becomes, how do you scale the organization? So that's the new part of where the value starts to accumulate. How effective is the organization? Not only the team, the core team, and so forth. And at this point, it's either awesome for investors who got in at the early phase, because they will have rights to invest in the later phase. They have first right to invest in the future round, so they are always in, so to speak, if they negotiated their terms right, or if they missed the boat. So now, if they missed the boat, it's not only that they missed that opportunity to invest early, they also missed the opportunity to invest in the future. Because as long as the investors who are already on board keep investing, what the amount of money that is needed, the new investors have no buy-in, or they have to pay significantly higher valuation. And this is basically how the market works from the investor's perspective. Again, the context of investors are used here to give better perspective on how the value of the company grows and how it's perceived from outside. Because us as entrepreneurs out of our own companies, we of course think the company is always much more than what the other ones think from the outside. So now, here the valuations can be even to 100 million. It depends totally on the market and the team and so forth. But again, the point here to communicate is not about the value, it's about the increased growth from the previous states. And establishing, now this is either that the company continues in the growth path, or it has reached certain level and it becomes more iterative growth. But the key here, it has become a machine, a normal organization that can attract necessary funding and resources, get funding, hire people, work on producing to continue to grow. And then it's an optional whether founders make an exit or continue with the company. In some cases, investors can make an exit and the founders continue, or it can be that everyone just continues as long as they see the progress. Again, valuation development and perspective into this matter. So now the customers part continues to grow because that's where the money comes from. Of course, they can be indirect customers. So customers in Facebook case would be the advertisers there. The value of organizations start to grow. The market is there, the product is there, but the product also is one piece because there can now be a second product, a third product, a service, additional revenue sources. But really the key then how the company continues to develop is that these things continue to align and be more balanced as a bigger organization. So now we are starting to see how the great company starts to formalize, having no dependency on any individual thing, having all the assets embedded into existing, being able to continuously deliver that value, capture that value to resource its needs of growth or operations. So, as a summary, when it comes to the valuation, your company development, communicate clearly. So define your key communication target group, so the key stakeholders, your own team members, extended team members, the advisors, the investors, the customers. Define the levels and the patterns, how often and in what format do you communicate to all of these key groups. Make sure to communicate your vision, target, plan to reach the target, and continue communicating about your progress. And all of these things are most important thing for your credibility and the ability to attract further resources. The more systematically and periodically you communicate to all key stakeholders, the more they will appreciate you as a company they are associated with or involved with. Too many entrepreneurs stop communicating to their key stakeholders other than customers perhaps. Always keep your potential investors, future investors, existing investors, advisors and mentors up to date of your development, because their ability to support and help you or to communicate about the activities of your company to their peers or friends or channels is totally dependent on how often do you give them reason to communicate and talk about your company. So learn to start this kind of communication pattern early on. So I want to highlight that while there's a lot of knowledge and content in here, there is no such thing as guaranteed success. There is no one truth, there is no one wisdom. This is just packaged information of knowledge that can be utilized and consumed and revisited. And there's much more detail in the future modules coming, diving much deeper into these specific phases and what to do inside that different phase. There is no one that can say, no matter what experience they have, nobody can say that will succeed, that will fail. Again, there's only likelihood of success, likelihood of failure. And that varies depending on who you ask and what background information do they have. But the further your journey has been, and the more you have documented process and systematic communication, the more credibility you will build up towards your future resource needs, whether those are people, finance, channels, customers, about your ability to execute. So the better you estimate your targets, the better you deliver on your plans, the more credibility you are, and the more new plans you present, the more people will believe in the success of the company. And that's a key thing. If you don't communicate, if you don't create this pattern, how would they justify getting involved? You don't want to give them a snapshot, you want to have them watching the movie and the story evolve and seeing what the story will develop into. If you only show one photograph every now and then, they don't necessarily understand the context. Also, regardless of how experienced someone is, they also can't guarantee that they can repeat the success. Because that's the whole point of innovation, is trying to create new value that wasn't created before and finding new markets for that value and also how it's being delivered. So there is no magic, there is no one way, but there are certain ways that you can reduce the likelihood of failure. So the things are really based on vision, clear mission, strategy, attitude, commitment, skills and learnings, tools and methods, determination and execution and experience, all combined, and all the things that you need to build for the company over time, not in day one. And it can be done, and it is all the time done. So all the time, new companies are finding this and making it work, and it is being done, and it's being done in high volumes. But the key things is that it is like sports, becoming an Olympic athlete, or even as simple as staying fit. Even if you know all the things that you should be doing, what matters is that you keep doing them. So if you know what needs to be done, then do at least those things that need to be done. It will increase the likelihood of success. And no one would imagine someone for somehow magically becoming, an Olympic winner in swimming of 400 meters or freestyle or whatever. Everyone knows what it takes to get to that level. Business is no different. Sure, there can be magical things happening randomly, but that cannot be done by design. If you're trying to do things by design, then there is models to. If you're only thinking that it's going to be luck, and somehow those who are successful, they are just lucky, well, there's certain truth to that. Those who are more active are more lucky. So even to win a lottery, you can increase the chance by buying tons of lottery tickets. And for a fact, you will never win a lottery if you buy no tickets ever. But that doesn't mean lottery is a smart thing to do. It's just an example. The likelihood is totally against you, so not a good idea. So to simplify this into a formula, so you need an idea, you need a timing, you need a plan, times execution. So the key is that even if you have idea, if you have good timing, if you have plan, but if you have no execution, none of those matter. So the execution part is the team, and that's why it's not a plus, it's a multiplier. So if execution is 0, none of those matter. And if we break that into more detail, so the plan is actually a set of initial assumptions times execution, and the execution is volume and speed times validating assumptions. So the speed is a key in the execution, and removing the failures. So you come up with initial sets, then you add more speed, and you add more validated learning-based new assumptions. So when you learn something, you remove the failures. Through the learning, you come up with new assumptions and you continue to execute. So the plan and execution opened up here.